Hello, everyone. Welcome to the TradeStation Masterclass. This is our technical analysis series where we, take on any technical idea and we talk about it. We drill down, dive deeper into its insides and see how it's calculated and how we should interpret it. Today is all about DMI and ADX. And I've selected these two studies because they're very similar in nature. In fact, ADX exists inside of a DMI study. We'll take a look at the insides, take a look at the calculations and see how that's possible. Let's do our introductions. My name is Jesus Nava. I am the Director of Client Training and Education for TradeStation Securities. And that is always a pleasure to be here talking about the platform. Let's go through some of the disclosures. Just keep in mind that every symbol and idea that I talk about is for educational purposes only. It is not a recommendation of TradeStation. Also, that active trading is not suitable for everyone, that it should only be done with risk capital, and that past historical performance is no guarantee of future results. If anybody needs additional information on these disclosures, please go to our website, www.tradestation.com/important-information. All right, guys, let's go ahead and get started. DMI stands for Directional Movement Index. By the way, let me share this PowerPoint with everyone here. Hold on. Okay, so the information that I'm going to be sharing with you is part of this PDF. DMI stands for Directional Movement Index. It was developed by Wells Wilder in the 1970s. We're talking about an indicator that's about 50 years or over 50 years old. But if it's still, part of a platform or a trading technology, it means that it's served well for traders and it still exists there. And there's still some value in that indicator that we're going to talk about today. DMI is made up of three indicators: DMI plus, DMI minus, and ADX. I'm not sure if this is true for every trading platform that is out there, but when you put the DMI indicator, the DMI study inside of TradeStation, you're going to see three lines: DMI plus, DMI minus, and ADX. ADX standing for Average Directional Index. All three lines compose the Directional Movement Index, or what we call the DMI. Let me switch over here to my TradeStation platform and show you exactly what I mean by that. Let me open up a brand new chart. Okay, let's pull up SPY on a daily chart. All right, and we're going to go to studies, add studies. It's part of the platform, so I'm just going to press the D so that it jumps to the D's or the studies that started with the D, and here's DMI. You can click on definition. Definition usually gives you additional information about how the DMI study works. This is a synopsis, so it's a summary of what the indicator or how the indicator should be interpreted and how it's calculated. We're going to go a little bit deeper into the DMI calculations than what is presented here, so hang on tight. Let's go ahead and put it on the chart. Okay, I'm not going to change any of the parameters. I'm just going to use it the way that comes out of the box. And this is what it looks like at the bottom of the screen. For somebody that hasn't seen, DMI before, it seems like it's an indicator all over the place. And it's kind of spaghetti on the screen, right? I mean, there's no clear direction, or at least, there's no clear signals on this indicator. We just see lines that look like an EKG. So let's go ahead and break it down so that we can understand it in more detail. When DMI plus is above DMI minus and ADX has a reading of 25 or higher, the current price momentum is said to be up and indicating a strong trend. Okay, there's a few things that are set here in this bullet point that we're going to repeat. We're referencing the DMI plus, the DMI minus, and the ADX, which are the three lines that make up this study on the TradeStation platform. Now the ADX, it says here a reading of 25 or higher. That's what we're looking for. In prior presentations, I've always told you guys that these kind of readings or these kind of levels that are established because that's the way that these indicators were looked at since they were developed, in this particular case, since the 1970s, may not apply anymore. So we always have to look at these values like that 25. We always have to look at these values with a grain of salt and determine if that's an appropriate level for the way that the markets are behaving at the moment. We'll get into that in a little moment when we look at examples and see how 25 may not be, sometimes the appropriate level that we should be looking at. But historically, a 25 level or 25 reading on the ADX was meant to be something significant. And let's go ahead and take a look. So we are referencing the three lines here: DMI plus, DMI minus, and ADX. And what it says is that if the DMI plus is above the DMI minus and ADX has a reading above 25, momentum is said to be up and indicating a strong uptrend. Let's go ahead and take a look at the chart here. What's happening right now? Well, I see, first of all, the ADX lines. The ADX line is the kind of yellow line in here, so the orange line. The blue and the red are my DMI minus and my DMI plus. The DMI minus being the red one and the DMI plus being the blue one. But if you look at the current bar, the DMI plus and the DMI minus are very close to each other. The plus is at 2803 and the minus is at 2569. Yes, the blue is above the red, and the ADX number here is not above 25. But I want you to be looking at what's happening here on the chart, and we know that we're coming from kind of a bottom right here. This it's created like a V shape right here, and the last few days the market has been turning up, which explains the reason why the DMI plus here is crossing above the DMI minus, because this indicator, what it does, it just measures where the prices are headed. Are they headed up or are they headed down? So whenever the DMI plus is above the DMI minus, it means that the price activity is favoring the upside. Not only that, but it also wants us to keep an eye on the ADX. The ADX right now, it's kind of turning down, which is something that should be concerning to the point that it's not a clear indication of a strong trend yet. Because the ADX, what it does, it just measures how strong the price movements are. And if we see that ADX line moving down, it's because the speed at which these prices are moving, it's probably not significant. But okay, let's go ahead and drill down a little bit more. We'll go back to the PowerPoint and see what other information is here. When the DMI minus is above DMI plus and the ADX has a reading of 25 or higher, the current price momentum is said to be down and indicating a strong downtrend. One of the nice things about, or one of the things or characteristics of ADX is that we're looking for a reading of 25 or higher for both a uptrend and a downtrend. Why? Because the ADX does not tell you the direction of price, but the strength at which the prices are moving. And that's why for both scenarios, we're looking for a higher reading because that is indicating a strong trend. The other two lines, the DMI and the DMI plus, the DMI minus and the DMI plus, the location, or if one is above the other, it's going to indicate whether the prices are uptrending or downtrending. Let's talk about ADX, which is the average directional movement. Now, this is another study, though. Let's go ahead and put it here on the chart. If I go over here to studies and add study, you're going to find that ADX is also available as a separate line. I'm going to put it right here on the chart so you can take a look at it. And I want you to see it closely because it's going to be exactly the same as the orange line on the DMI. Let me do something here so you can have a better visual. Let me double click on the DMI, and in the style tab, I'm going to make the DMI transparent, and the DMI, both DMIs, I'm going to make them transparent. And I'm going to click OK. And I want you to take a look at that line. Does it look like it's exactly the same? It does to me, you know, it's kind of moving exactly the same. It's using the same parameters, the ADX, it's using 14. So yeah, you can see that it matches exactly. So you can already see, the only reason why it looks kind of a little bit different is because of the scale. You know, if you look at the scale of the ADX here, only goes up to 36. This indicator up here goes up to 45. There's a slight difference. So it's kind of squashing the ADX a little bit, but it's exactly the same calculation. The ADX study that we have as a separate study in the list of studies in TradeStation is just the ADX value without showing you the DMI minus or the DMI plus, which pretty much tells you how strong the market moves. And if you look at the green line right here, the green line of the ADX study is set at 20. We already said in the PowerPoint that we're looking for a reading that is higher than 25. But take a look at the ADX that is built into the TradeStation platform. It also looks at that level of 20 as a significant level. So this is just telling you that it's not really a hard-coded number. It's not a number that is set in stone. It's something that we should always look at and find if it's appropriate to the way that the markets are moving. So that's the ADX. Let's talk a little bit about ADX and some of its characteristics. As we said previously, ADX measures the strength of a prevailing trend, as well as whether movement exists in the market. The lower the reading, the less the markets are moving. The higher the reading, the faster the markets are moving. So I should have just gone to the bullet point, right? Low ADX values can indicate a non-trending market with low volatility, whereas a cross above 25 may indicate the start of a trend, either up or down. Again, we mentioned that 25, and I'm going to emphasize that you should always look at that value and make sure that it's appropriate to the market that you're looking at. Let me come over here to my chart. Let's look at historical values. These are historical values for the ADX. And, you know, if we take that line, let me see if we can change that line. We'll go to the inputs. If I change the trigger level to 25, you know, the trigger level at 25, I feel that it's very high for spiders. You can see that it's not a common occurrence for the ADX to be above the 25 trigger level. I mean, you miss out on a lot of trending opportunities that have happened in the past. And, you know, and I'm not sure if that's because of the markets, the way that the markets have changed, or, but this has affected, you know, that level of 25. You see, it's missing all of these bottoms. You know, when you're looking at a level where the market is turning, yeah, it's coming back from a low, but you don't want that level to be so much higher that you're actually missing out on a good entry signal. Based on, you know, this level 25, it just means that I would be missing out on entering or making my entries a little bit more efficient. You know, even the 20 reading, it's kind of high. You know, I would test, you know, this value and make sure that I'm using a level that is appropriate to the market that I'm trading. You know, right now I can see the market right now approaching that 20 reading. But again, when I look at the ADX is just a measure of trending markets. And I see that ADX, you know, turning down. Maybe it's got to do because of the way that the bars are moving. Maybe it's got to do because of the way that the prices are increasing or decreasing, so it's got to do with a lot of that. We're going to take a look at the formula and how all these values are calculated. Will give us a little bit more insight about how we should, absorb the value or digest the values that the ADX is giving us. Let's go here to the PowerPoint. If the ADX is over 40 and begins to fall, it can indicate the slowdown of a current trend. This indicator can also be used to identify non-trending markets or a deterioration of an ongoing trend. So again, on the other side, we have the high readings. So it's looking at a rating of 40. If it goes to 40 and it begins to fall, it may be just an indication that the trend is over. So the ADX, if you look at these two bullet points combined, it seems like it's a great indicator for you to use when you're looking at trending strategies or when you're trading trending strategies, when you are on a long trade or a short trade and you're riding, the trend, because the ADX is a measure of price movement. So if the readings are low, it may be because you're not in a trending market. So it may not be a good idea to put in on a long-term trade. The same thing happens if the readings are high. If the readings are high, it's because it's trending pretty rapidly. But if you see that ADX turning down, then that could be an indication that, the trend has lost steam and is ready, to give up and maybe go into a consolidation pattern. So those are the two extremes. Now it's referencing a value of 40. Let me switch over to my trade station and set this to 40. Take a look. Has the ADX ever been at 40 on Spider? Well, not on this chart. This chart goes back to September of 2020. So we have 2 years worth of historical data. Let me load more. So historically, yes, right here, September 2nd, 2020, March 2020, October 2018, and January 2018. Those are the only 4 times in the past 5 years that the ADX has gone above 40 for Spider. It may be very isolated cases. So when you look at the PowerPoint and it says if the ADX is over 40 and begins to fall, it can indicate a slowdown of a current trend. That it's completely inaccurate if we look at Spider as an example, because we are not going to say here, we're going to say here that there's not been consolidation periods in the past, 2 years. And the past 2 years, the ADX has never been above 40. In fact, if we look at the highest point right here, it's never been higher than 36. So that's when I always say and emphasize that when you look at statements like this, always look at the tops and bottoms of the indicator so that you can get a good understanding on how the ADX numbers are moving for that particular market. So if I want to have a great reference here, maybe I would draw an imaginary line right about 30. So if I bring this down to 30, so we can see a relationship between low readings, for example, right here, it correlates to this top on Spider. And as the ADX was moving up, that is just an indication that the trend is increasing its speed. And of course, that correlates to this downtrend that happened on Spider. This was, May of this year. It reached an extreme right at this point, and then it started turning down, giving you an indication that maybe the prices were not going to go down any longer, that it's maybe they were consolidating. In fact, you can see how Spider moved sideways for about a whole week or even, 7 or 8 different days. It just moves sideways. It lost its speed. Right here is reflected by this ADX reading. But then again, we get another spike represented by this downtrend, and we can see the readings in relationship to what the market is doing. But what I'm trying to say is that notice that I had to lower that level to 30 just to make some sense out of the ADX readings for this particular symbol. Although market direction is important in its calculation, the ADX is not a directional indicator. We already established that, and it's something we need to remember. It doesn't correlate to tops and bottoms. You know, the low readings here for the ADX doesn't mean that it's time to, you know, go long or short. It just means that the speed by which the prices have moved has lost its magnitude, has lost its intensity. Okay. ADX is used to quantify trend strength. An ADX reading above 25 or not may indicate that the trend is strong enough for trend trading strategies. Again, take that 25 level, make sure that you're looking at the ADX and don't take that 25 for granted. From low ADX conditions, price will eventually break into a trend. So what we need to identify is those low ADX conditions. What is a low for this particular symbol that I'm looking at? You know, going back to my example here, you know, I see the lows right here. I need to visually draw a line that includes most of these. Maybe a level at 20, which is the level that it started off with, would be appropriate for this, you know, because now it covers this. Whenever it reaches that bottom, maybe an indication that something's going to happen. When things quiet down in the market for a period of time, you know that something is due to happen. The market can only sustain, you know, those periods of low volatility for a short period of time. And we just want to make sure that we are in and that we are aware of the signal when the ADX kind of is telling us, you know, the market's speeding up. When the ADX line is rising, trend strength is increasing, and the price is expected to move in the direction of the trend. A falling ADX line may indicate that the trend strength is weakening. And that's it. Let's talk about the calculations, a little bit of math. I'm not gonna, you know, bring out the math textbook, but it's important that we know where these values are, you know, calculated from. For the DMI and ADX, we need to calculate true range. We need to calculate DMI plus and DMI minus. Well, I didn't provide the formula for true range because I think most of us know how true range is calculated. And if you don't, you know, it's the range of the bar. The range of the bar is the high to the low, but it looks at the closing price of the previous bar. So if the closing price of the previous bar was higher than the high or lower than the low, it's going to extend the current bar's range to that closing price. That's what's considered the true range, taking into consideration where the price was the bar before. Now, when it comes to DMI plus and DMI minus, interesting calculation, because the way that it works is that it's going to look at two bars in particular, and it's going to take a look at the difference between the highs and the difference between the lows. But take a look, it looks at the current high minus the high of the prior bar, and it's looking to see if that's greater than the low of 1 bar ago minus the low. If that is true, then DMI plus equals the high minus the high 1 bar ago, or 0. So let's go ahead and take a look. I'm going to look at some bars here to see if I can make some sense out of this. Okay, let's take a look. Let me remove these indicators so that they're not in the way. So I'm going to look at, this is the daily chart. Okay, that's fine. I'm going to take a look at these two bars. So let's draw some horizontal lines so that we know what the prices are. Drawing, I'm going to remain in drawing mode. I'm going to drawing horizontal lines. Let's draw, and I'm going to turn snap mode on because I want a line right here, line right here, right here, and right here. I'm just adding 4 lines to the high and the low of these 2 bars. In fact, let me draw an arrow so that we know which ones we are talking about. So we're talking about this one, and we're talking about this one. Okay, let's go ahead and remove snap mode. Let's remove these 2. Okay, so where the 2 arrows are, that's what we are going to be looking at. Let me go ahead and increase my bar spacing. So according to my PowerPoint, we're saying that the high minus the high 1 bar ago. High of this is 406 minus the high 400. So we're talking about 406 minus 400 gives us about 6. Let's just keep that, let's just round the numbers so that we don't overcomplicate. 6. But then it says low of 1 bar ago minus the low of the current bar. So if we look over here, we have the low over here minus this low. So we're talking about 394 minus 402. That gives us a negative number. So we have a positive number here and we have a negative number here. So this condition is actually true. What does that mean? That the DMI plus equals that value, $6. Does that make sense? Now, on this other side, low 1 bar ago minus the low, this is the exact same formula, but inverted. What it's looking for, if the other is not true. So for example, if we know for a fact that this is a negative number and this is a positive number, so this is not true, then DMI equals 0. So what it's trying to do is on every 2 bar comparison, it's going to look at the highs and it's going to look at the lows. And whichever one of these is true, that increase in price is going to be added to the specific bucket. So if this one is true, then it's going to, you don't see me pointing here, right? So let me go to laser pointer. There we go. So we're looking at the DMI. If this condition is true, it's going to add, as we figured out, the $6 into the DMI plus bucket. This other condition actually turned out to be false because this is negative, this is positive, this is not true. So when it's not true, we set it to 0. So this is like the battle between candlesticks, or you can call it bars, the battle between bars, where if the highs, it looks at the highs and looks at the lows. If the highs are the ones that are winning or that are greater than the lows, then it's going to add that value to the DMI plus. So you can already tell that if you have an upward or a market that is trending up, the highs are mostly going to be higher than the lows, and it's going to be adding those values to the DMI plus bucket. So this is the reason why the DMI plus and the DMI minus provide you a sense of direction. Where is the market headed? Because it keeps track, of whether there's more intensity to the upside than there is to the downside. If the DMI plus and the DMI minus are both negative, then they're both set to 0. If they're both positive, the larger retains its value and the other is 0. So it's always like a battle between these 2 calculations, and whichever value is bigger, that value gets added on to its bucket, the other one is set to 0. And that's how the values are calculated from bar to bar. Well, not yet, because after it puts those values into the buckets, it's going to smooth the true range, the DMI and DMI minus, using Wilder's smoothing technique. A lot of these calculations, by the way, are part of the easy language code. So for anybody that has questions about how is this calculated, what is the mathematical formula used, open up the DMI. Let me open it up here and show you how it's done. I'm going to go to my DMI. You know, from the DMI study, you can just right click and then edit easy language for DMI. That opens up the code. You can see how the DMI is not very long. You would think that it's a very long piece of code, but it's not. It's only about 35 lines of code because it references a function that is named directional movement. The whole DMI indicator relies on that function because this is the function that calculates DMI plus, DMI minus, and it also calculates ADX. So all the calculations are happening inside of the function. This is what's called a multi-output function because it provides you many calculations. But if we open up the directional movement, let me open it up for a moment. This is where most of the calculations are happening. This function right now has about 100 lines of code. But if I come over here where, let me just open up the code here. You see where it's, you see some variables here that are named SF. That's a smoothing factor. So this is the part where smoothes out the DMI minus, the DMI plus, and that also smoothes true range. Not to get into a lot of detail, but I wanted to show you where the math is, just in case you want to know where the value comes from. Whenever I look at a value, I want to know how it's calculated, and I always refer to the formula to see where that number came from. Once you do that, the DMI plus is calculated by taking that smooth DMI plus, dividing it by the smooth true range times 100. And the same thing is done with the DMI minus. You can see there's a little bit of math, but that's where the value comes from. Once you plug in the values in here, you get the DMI plus and the DMI minus reading. The DX, which is directional movement, this bullet here that is right here at the top, is one step before we actually get the ADX. The DX, which stands for directional movement, is the absolute value of the smooth DMI plus minus the smooth DMI minus divided by the sum of smooth DMI plus smooth DMI minus multiplied by 100. I know when you put it in Word, it's kind of confusing, but if you picture the formula inside of your minds, it clarifies it a little bit. One step before we reach the ADX, which is the average of the directional movement. Okay? Not to overthink it, but I wanted to put this in here so that you can digest it and then make some sense out of where the values come from. The ADX R is just the smoothing of the ADX value over a certain number of bars ago. What is this all telling us? Well, let's take a look. If I come over here and I put in the other studies, let me go to studies, add studies. We already saw that the ADX was very similar to the DMI. Okay, so yes. Here on the DMI, we went to the style and we made the DMI plus and the DMI minus transparent so that we could see the ADX, right? So now you can see the line similar to this one and similar to the blue line right here. Let me go ahead and make the ADX R a transparent line. You can see that all three lines here are exactly the same because it's plotting ADX. ADX R, of course, has a smoothing line, which is right here. The magenta line is just an average of that ADX. So the indicators, the three ones, are giving you the same statistics. They're just reading it differently. The one that's called DMI includes the DMI plus and the DMI minus, which gives you a little bit of where the trend is going. Without the DMI plus or the DMI minus, you would not know, which way the markets were going. Whenever the DMI plus is above the red or DMI plus is above the minus, we are in a bullish market. And whenever the DMI minus is above the plus, we are in a bearish market. So a combination of all those three lines is what tells you direction and strength. The other two indicators, ADX and ADX R, are just a measurement of the trend. Is it moving fast enough? If it's slow, if there's no trend, that's what the ADX and the ADX R are trying to give you. The ADX R differs from ADX in that the ADX R is less sensitive to short, quick reversals because the ADX R results in a smoother calculation. We know that sometimes that favors your trading entry, but sometimes it hinders it, depending on how quickly it reacts. So sometimes smoothing too much works against you because you kind of get in late. So sometimes you want the sensitivity, sometimes you don't. So it depends on the market and which way it's headed. It was developed, the ADX R was developed to compensate for the variance of excessive tops and bottoms. And of course, provides information pertaining to the strength of a trend, helping you manage the risk of trading in volatile markets that fluctuate between trending and non-trending. So that's the reason why we have these smooth ADX values so that you don't get whipsawed in markets. So it's not so sensitive to the ups and downs. And that's it. What are the trading observations for the DMI and the ADX? Things to consider. We already said it. DMI plus crossing above DMI minus indicates a bullish signal. DMI plus crossing below the DMI minus indicates a bearish signal. ADX helps you identify the trend strength, not the direction. And traders may use the slope of ADX to make trading decisions. If the slope is just talking about the angle, if it's turning up, you know that the prices are trending. But if you see it turning down, maybe the trend has lost its intensity. An ADX value greater than 25 may imply a strengthening trend. Always, make sure that you are looking at historical values to make sure that the 25 reading makes sense. The ADX R, the slope of ADX R implies or helps confirm a trend. And the DMI and DMI minus, DMI plus and DMI minus may move away from each other when price volatility increases and may converge towards each other when volatility decreases. So you see that very clearly here on the DMI study. You see, whenever we have these tops and bottoms on the price, let me remove these horizontal lines so they're not distracting. That usually correlates to a cross on these two lines. For example, right here, we can see how the lines crossed at this precise level. It went from the red being at the top for the blue to cross over. This would have been a bullish signal. And notice that correlates with this uptrend. And now see how the negative is on top. It correlates here with this turning point for the spiders. A lot of these analysis can be turned into a strategy. And I talk about this in my last presentation where technical indicators can be converted into strategies so that you have an understanding on either whether a signal works or not. So I would recommend that anybody that is interested in DMI and the signals that are being generated to convert this into a strategy so that you can backtest that idea against historical data and have a more comfort level in trading this concept. And that's it. That's my class for today. Wanted to give you a little bit of insight about what the DMI and the ADX indicators were trying to tell you. Always refer to the notes here in this PDF to have a reminder of what the different lines are and how they were calculated. But thank you guys for joining me today, and thank you for being part of the masterclass. I want to encourage everyone to check out the content of the channel and wish everyone a happy weekend. I'll see you guys on Monday. I'll talk to you later. Bye-bye.